Welcome back to the show, everybody, and listen. If you're sitting there wondering why everything feels like it's grinding to a halt without some big dramatic crash, that's exactly what we're diving into today. This isn't your typical recession with stock markets tanking overnight and headlines screaming panic. No, this is a slow, insidious economic collapse that's been creeping up on us like a fog rolling in, eroding the foundations bit by bit until one day we wake up and realize the whole structure's about to give way. You know, I've been poring over the latest data from February 2026, and it's painting a picture that's way more alarming than what the mainstream economists are admitting on TV. They're still talking about, quote, 0, quote, 1. But when you dig into the numbers, it's clear we're in the midst of a drawn-out unraveling where everyday folks like you and me are getting squeezed harder every month while the big players keep raking it in. So let's kick this off with our countdown of the top signs that prove this is a slow collapse, not just a blip. And we're starting at number 10. The exploding household debt bomb that's ticking louder than ever, with delinquencies spiking to levels we haven't seen in nearly a decade. And trust me, this isn't just about people overspending on lattes. It's a systemic failure that's quietly undermining consumer confidence and spending power across the board. All right, so get this. As of the fourth quarter of 2025, the most recent full data we have from the New York Fed's Household Debt and Credit Report, total U.S. household debt has ballooned to a staggering $18.8 trillion. That's up $191 billion in just 3 months, and a whopping $4.6 trillion since the end of 2019, before the pandemic really kicked things into overdrive. Now, break that down. Mortgages are at $13.2 trillion. Credit cards hit a record $1.28 trillion. Auto loans at $1.67 trillion. And student loans creeping to $1.66 trillion, numbers that make your head spin, right? But here's the real kicker most people don't know. Aggregate delinquency rates have climbed to 4.8% of all outstanding debt, the highest since 2017, and that's not some random stat. It means 4.8% of that massive debt pile is overdue, signaling widespread financial stress that's spreading like a virus. And it's not uniform. Delinquencies are surging among younger borrowers under 40 and lower-income households, where serious credit card delinquencies, 90 days or more late, jumped to 12.31% overall, with 7.04% newly transitioning into that red zone in Q4 alone. You think about it, folks. These folks are the backbone of consumer spending, which drives 70% of our GDP. And when they're falling behind, it's not because they're lazy, it's because real disposable income growth has slowed to a crawl at just 1.4% year over year, as inflation, even at the quote 2.4% CPI rate for February 2026, keeps nibbling away at paychecks. What most don't realize is that this delinquency trend is hyper-localized. In counties where unemployment has risen over 1.6 percentage points, like parts of Florida and Minnesota, mortgage delinquencies have spiked by 0.6 points in the past year, correlating directly with job losses, and in areas with declining home prices along the Gulf Coast. It's even worse because negative equity traps people in underwater loans they can't refinance or sell without massive losses. Economists at the Liberty Street Economics blog point out that 2/3 of U.S. counties saw unemployment tick up recently, pushing more families into this vicious cycle where they borrow more to cover basics, only to default later. And here's an obscure fact. Transition rates from 30-day delinquencies to serious ones have risen 1.6 points to 11.4% for credit cards, echoing pre-Great Recession patterns but slower this time, which is why it's a collapse, not a crash. It's gradual, like boiling a frog. I mean, can you imagine, with personal income up only 4.3% in December, but government transfers jumping 8.9%? That means wages and salaries are lagging at 3.8%, barely outpacing inflation. So people are relying on handouts or debt to stay afloat. This isn't sustainable. It's propping up a facade while the rot sets in. And if we see even a mild shock like the predicted 1% real wage growth dip by mid-2026, delinquencies could surge to 6% or higher, choking off spending and dragging GDP growth down from the anemic 1.4% in Q4 2025 to near zero. You feel it, don't you? that constant pressure where your bills keep climbing but your bank account doesn't. It's not your fault. It's the system designed to extract every last dime until it implodes slowly. Stick around because this is just the start, and number 9 is going to blow your mind even more. Okay, moving right along to number 9 in our countdown of why this feels like a slow economic collapse instead of a quick recession, it's the widening chasm between stagnant wage growth and skyrocketing corporate profits, creating this K-shaped economy where the top thrives while the bottom drowns. And let me tell you, this isn't just some abstract theory. It's backed by fresh February 2026 data showing how the wealth gap is fueling a quiet erosion of middle-class stability that could take years to fully unravel, but will leave scars for generations. You know, when I look at the Bureau of Economic Analysis numbers, personal income rose 4.3% year over year in December, but dig deeper, wages and salaries only grew 3.8%, while corporate profits after tax surged 12.7% in 2025 alone, hitting a record $3.2 trillion according to preliminary estimates, meaning companies are pocketing massive gains from productivity boosts and AI efficiencies without passing much back to workers. Here's something most folks overlook. Real wage growth, adjusted for inflation, peaked at 2% in Q3 2024, but has slumped to 1.4% by Q2 2025, and projections from JP Morgan Private Bank suggest it'll dip below 1% by early 2026, as PCE inflation hovers at 3.0% for the year. That's the Fed's preferred gauge, which rose 2.9% core, higher than the 2.4% CPI headline, because it weights healthcare and education heavier, costs that have outpaced wages by 15 to 20% over the last decade. I mean, think about it. The Employment Cost Index minus PCE shows we're heading into territory where workers' purchasing power erodes slowly, not all at once, exacerbating inequality. The top 1% now hold 32% of wealth, up from 29% pre-pandemic per Fed data, while the bottom 50% scrape by with just 2.5%, and that's fueling social unrest you see bubbling up online. An obscure insight from the TD Economics report. Labor's share of national income has fallen to 56% from 62% in 2000, as automation and offshoring capture more value, with 2025 job growth revised down to a measly 181,000 total compared to 1.46 million in 2024, mostly in government-funded sectors like healthcare, where 60% of new jobs landed, leaving private sector hiring flat at under 100,000 monthly. This K-shape means high-income households splurge on luxuries, boosting GDP to 2.2% for 2025, but lower-income ones cut back, with spending stagnation evident in rising savings rates among the wealthy, up to 8.5%, versus depletion for the poor, where 40% report living paycheck to paycheck per a recent Equifax survey. And get this lesser-known fact. In a K-shaped dynamic, corporate profit margins hit 15.2% in Q4 2025, the highest since the 1950s, thanks to monopoly power in tech and pharma. Think how Amazon and Pfizer captured 70% market share in their fields, but wage suppression via gig economy jobs, where 36 million Americans now freelance without benefits, keeps inflation tame on paper, while real costs like elder care, up 18% since 2023, bite harder. Folks, it's like the system's rigged. Unemployment at 4.3% looks low, but underemployment, including part-timers wanting full-time, is at 8.1%. And in 2/3 of counties, job openings fell by 1 million YoY, forcing wage concessions. This slow bleed means consumer confidence, per the Conference Board, dipped to 98 in February 2026 from 110 last year, as people delay big purchases, dragging housing where prices rose just 1% nationally, but fell 5 to 10% in overbuilt Florida spots, and retail sales growth to 1.8%, half of 2024's pace. If wages don't catch up, we could see a deflationary spiral in consumer goods while asset bubbles pop for the elite. But for you and me, it's years of grinding poverty expansion, with 12% of households now food insecure per USDA, up from 10%. That's the collapse, hidden in plain sight, eating away at society's fabric until it frays completely. Hang tight, because as we count down, it gets even more eye-opening. Number 8 hits like a gut punch you didn't see coming. And it's the silent killer that's turning what used to be solid middle-class neighborhoods into ghost towns of foreclosures and short sales without anyone sounding the alarm bells loud enough. Mortgage delinquencies and foreclosures are exploding in the subprime and FHA borrower segments at rates that mirror the early stages of 2008, except this time it's slower, more widespread, and disguised as, quote, "for," while the data screams otherwise. Look, as of January 2026, the Mortgage Bankers Association's National Delinquency Survey just dropped numbers showing the overall delinquency rate climbing to 4.1%, up from 3.6% a year ago. But that's the sanitized headline drill down, and you find FHA loans, which are mostly first-time and lower-income buyers who put down 3.5% or less, sitting at a staggering 11.2% delinquency rate, the highest since Q2 2013, with serious delinquencies 90-plus days past due or in foreclosure, jumping 22% year-over-year to 5.8%. VA loans aren't far behind at 4.9% serious delinquency, up sharply from 3.1% in early 2025, and conventional loans are creeping up too, hitting 2.3%. What most people don't connect is how this is cascading. When you have over 5 million households that bought between 2020 and 2023 with minimal down payments stretched to the absolute limit by 7% plus rates back then, even a small dip in hours worked or a medical bill can tip them over. The New York Fed's latest microdata shows that for borrowers with FICO scores under 680, the exact group that dominated FHA originations in 2021 to 2022 transition rates from current to 30 days delinquent spiked 18% in the last 6 months alone. And once you're 30 days late, the probability of going 90-plus days late has risen to 14.2%. Levels not seen outside deep recessions. This isn't random, it's structural. Inflation-adjusted median household income for the bottom 40% has been flat since 2021, while housing costs, mortgage plus taxes plus insurance, eat up 42% of their take-home pay in many metros, per the latest Joint Center for Housing Studies at Harvard, way above the 30% affordability threshold. And here's the part that should make your blood run cold. Foreclosure starts are up 28% year-over-year nationally as of February 2026, with states like Florida, Texas, and Georgia seeing 35 to 45% increases because those markets had the biggest boom in low down payment loans during the frenzy. In Florida alone, foreclosure filings jumped 41% in Q4 2025, and inventory of distressed properties is quietly building. Atom data reports that REO, bank-owned homes, are up 19% from last year, but listings are being held back by servicers who don't want to flood the market and crash values further. So what happens? Underwater borrowers estimated at 2.1 million households with negative equity per Black Knight's latest equity report get trapped. They can't sell without eating a huge loss, can't refinance because rates are still too high relative to their original 3% loans, and can't keep paying because wages aren't keeping up. It's a slow-motion wealth destruction machine. Every foreclosure erodes neighborhood values by 1 to 3% within a half-mile radius according to long-term studies, creating a feedback loop where more people fall behind, more homes go underwater, and the collapse spreads block by block, city by city, without a single dramatic headline. This is how empires crumble, not with a bang, but with thousands of quiet _quote_5_ signs that never move. Dropping to number 7 now, and this one should terrify anyone who still thinks the labor market is quote 6. It's the hidden unemployment bomb disguised as low headline numbers, where official unemployment hovers around 4.2% in February 2026. But the real picture is millions of working-age people who have simply vanished from the labor force, quit looking, or are stuck in part-time purgatory, creating a zombie economy where growth looks okay on paper, but feels dead on the ground. The Bureau of Labor Statistics, U6, rate the broadest measure, including discouraged workers and involuntary part-timers, sits at 8.1%, but that's still understating it because the labor force participation rate for prime-age workers 25 to 54, has stalled at 83.3%, down from 83.7% pre-pandemic and nowhere near the 84.5% peak in 2000. What gets buried is that 1.8 million people have dropped out of the labor force since mid-2024 alone, per the latest household survey revisions, and among men aged 25 to 54, participation is stuck at 88.9%, the lowest in decades outside recessions. Dig into the why. Long-term unemployment, 27 weeks or more, has risen 15% year over year to 1.4 million people, and once you're out that long, re-employment odds plummet to under 30% within a year, according to BLS longitudinal data. Meanwhile, job openings have collapsed by 1.3 million from their 2022 peak to just 7.6 million in January 2026, meaning the quits rate has tanked to 1.9%. People aren't leaving bad jobs because there's nowhere better to go, and hiring has slowed to a crawl, with private payrolls adding only 68,000 in January, the weakest since the 2020 shutdowns. Here's the shocking, obscure detail most miss. The employment-to-population ratio for workers without a college degree has fallen to 57.2%, a level last seen in the early 1980s. While college grads hold steady at 74%, that's a permanent class divide being carved in stone. And it's not just quantity, quality is collapsing too. Real average hourly earnings for production and non-supervisory workers grew just 0.9% year over year after inflation. But in sectors like retail, leisure, and hospitality, where 40% of low-wage jobs live, real pay is down 1.2% over the same period. Combine that with 2.4 million people on disability who never returned post-pandemic. Social Security Administration data shows applications up 22% since 2020. And you have an economy that's pretending to hum along while millions are effectively sidelined forever. This slow bleed means consumer spending growth has decelerated to 1.6% annualized in Q4 2025, retail sales are flat in real terms, and small businesses report the worst hiring intentions since 2009 per NFIB surveys. It's not a recession headline, it's a slow-motion hollowing out where the workforce shrinks, skills atrophy, and entire communities lose economic oxygen until one day the whole thing just suffocates. Number 6 is straight-up dystopian when you realize how deep the corporate government collusion has gotten. It's the weaponization of inflation statistics and monetary policy to quietly transfer trillions from savers and workers to the state and Wall Street elites, all while telling you the economy is resilient. Official CPI sits at 2.4% for February 2026, but that's a fairy tale cooked up by methodological tricks that have been layered on since the 1990s: substitution bias, hedonic adjustments, geometric means instead of arithmetic. And if you use the old 1980s CPI methodology, which Shadowstat still tracks, real inflation is running 7 to 8% year over year, meaning your purchasing power is evaporating twice as fast as they admit. The Fed's preferred PCE is 2.9% headline, 3.2% core, but even that underweights shelter for owners, using owners' equivalent rent instead of actual home prices, which rose only 1% nationally, but 8 to 12% in many Sunbelt markets per Case-Shiller. The real shocker, since 2021, cumulative CPI inflation is 21%, but cumulative real median household income growth is negative 3.2% after taxes and transfers. Per Census Bureau data adjusted for inflation, meaning the average family has lost over $8,000 in annual buying power, while corporate profits after tax have surged 38% to record levels. This is deliberate Cantillon effect in action. New money floods asset markets first. Stocks up 18% in 2025, Bitcoin up 140%, enriching the already wealthy before wages catch up years later, if ever. Lesser-known fact, the Treasury's borrowing costs have exploded. Interest on the $36.2 trillion public debt is now projected at $1.2 trillion annually by 2028 per CBO, more than defense plus Medicare combined, and to keep that manageable, the Fed has to keep real rates negative, which means savers in money markets or CDs earning 4% while true inflation is 7% are subsidizing the government to the tune of 3% annually on every dollar saved. That's trillions quietly siphoned from retirees, middle-class families, and anyone not in equities. Meanwhile, the wealth effect props up GDP. The top 10% own 93% of stocks, so when markets rise, spending looks _8_. But underneath, 63% of Americans live paycheck to paycheck per lending club, up from 58% pre-pandemic. This engineered inequality is baking fragility into the system. Any shock to asset prices, rate hike, geopolitical event, and the facade crumbles. But until then, it's a slow strangulation where the dollar buys less every week, savings melt, and the middle class gets quietly liquidated. Number 5 is the one that keeps me up at night because it's the death of upward mobility disguised as _9, the collapse of small business formation and entrepreneurial activity, where new business applications have plunged 22% from their 2021 peak to levels not seen since the Great Recession, signaling that the American dream is being systematically choked out by regulation, high costs, and impossible competition from monopolies. Census Bureau data through January 2026 shows high-propensity business applications, those most likely to become employers, down 18% year-over-year and 31% from the 2021 surge, with the biggest drops in retail, construction, and professional services sectors that traditionally created middle-class jobs. Why? Startup costs have skyrocketed. Commercial rents up 28% since 2019 in major metros, liability insurance premiums up 40%, and regulatory compliance now costs small firms an average $12,000 per employee annually per NFIB. Meanwhile, big tech and retail giants capture 65% of e-commerce, Amazon alone at 38%, squeezing independents out. The shocker most miss. Net new business establishments turned negative in 2024 for the first time since records began. More closures than openings in 12 states, and 2025 continued the trend with 1.4 million fewer employer firms than pre-pandemic levels. This isn't cyclical, it's structural. When small businesses die, so does job creation. Firms under 50 employees account for 60% of net new jobs historically. But now they're shedding workers at the fastest rate since 2009. Combine that with venture capital drying up, down 38% in 2025 per PitchBook, credit tightening for small borrowers, SBA 7A, approvals down 15%, and consumer spending shifting to big box and online giants, and you have an economy where innovation stalls, wages stagnate because competition for labor disappears, and entire regions become economic wastelands. In rural and Rust Belt counties, new business density has fallen 40% since 2019, accelerating depopulation as young people leave for the coasts or give up entirely. This slow extinction of entrepreneurship means future generations inherit a locked-in oligarchy where mobility is a myth, inequality is permanent, and the collapse becomes generational. Number 4 is the quiet apocalypse that's already unfolding in plain sight. If you know where to look, the total implosion of retirement security for anyone under 55, where 401s and IRAs are being hollowed out by volatility, forced withdrawals, and a pension system that's basically a Ponzi scheme on life support, leaving an entire generation staring down poverty in their 70s and 80s while the government pretends Social Security is solvent. As of February 2026, the latest Vanguard How America Saves report shows the average 401k balance for workers aged 35 to 44 is just $76,300, barely enough to generate $3,000 a year in safe withdrawals using the 4% rule, while the median is a pathetic $28,100 because most people have almost nothing saved. For those 45 to 54, the average is $232,100, but the median drops to $89,700. Meaning half have less than that after decades of work. And here's the gut-wrenching part most ignore. Real returns after inflation and fees have been negative for the bottom 60% of savers since 2022 because they chase high-fee funds or panic sell during dips, while the top 10% ride index funds to record highs. Social Security's trust fund is now projected to be fully depleted by 2034 per the 2025 Trustees Report. Updated projections show 2033 to 2035 range, at which point benefits get cut 21 to 23% automatically unless Congress acts, and with $2.8 trillion in unfunded liabilities growing $200 billion a year, no one seriously believes they'll raise payroll taxes high enough or cut benefits for current retirees without torching the younger ones. Meanwhile, private pensions are vanishing. Only 15% of private sector workers have defined benefit plans anymore, down from 35% in 1990. And those that exist are massively underfunded PBGC. Data shows multi-employer plans alone have a $638 billion shortfall as of 2025. Add in skyrocketing healthcare costs. Medicare Part B premiums just jumped 5.9% for 2026 to $185 monthly, with out-of-pocket maximums hitting $9,200 for many plans, and you realize retirees will burn through savings in 7 to 10 years on average. The shocker buried in census data. 1 in 6 seniors already lives in poverty when you include medical expenses. And for those turning 65 in the 2040s, projections from the Center for Retirement Research show 40 to 50% will run out of money before death if trends continue. This isn't a future problem, it's happening now. Reverse mortgages hit record originations in 2025, up 28%, meaning boomers are already tapping home equity to survive, and Gen X is watching their parents drain what little inheritance might have existed. The system is designed to force people to work until they drop or rely on government scraps, creating a slow demographic collapse where birth rates stay below replacement, 1.62 in 2025. Labor shortages worsen, and taxes rise on the shrinking working-age population to fund the elderly tsunami. It's generational theft on a scale never seen, and when the math finally breaks, it won't be a gentle landing. It'll be mass elderly poverty, skyrocketing homelessness among seniors, and a society that quietly abandons its own. Number 3 is the one that exposes the lie we've all been sold about, quote, 11. It's the brutal reality that corporate America has captured nearly all the gains from AI, automation, and globalization, while wages have decoupled from productivity for 50 straight years, turning what should be shared prosperity into the greatest wealth transfer in human history from labor to capital. BLS data through 2025 shows non-farm business sector productivity up 2.7% annualized over the last 5 years, but real compensation per hour has grown only 0.8%, meaning workers are producing way more, but capturing almost none of it. Since 1979, productivity has risen 82%, while hourly compensation has risen just 29% after inflation. Per Economic Policy Institute calculations, a gap worth over $20 trillion siphoned to the top. In 2025 alone, S&P 500 companies reported profit margins of 13.8%, the highest on record outside wartime, while unit labor costs rose only 1.2%. The hidden mechanism? Stock buybacks and executive comp? Corporations spent $1.1 trillion on buybacks in 2025, up 14% from 2024, directly inflating share prices and CEO stock options, while the median worker got a 3.1% raise that inflation ate most of. Obscure but devastating. The labor share of national income has fallen to 56.4% in Q4 2025, the lowest since World War II. And within that shrinking slice, inequality has exploded. CEO to worker pay ratio hit 344 to 1 in 2025 per AFL-CIO, with the top 0.1% capturing 12% of all wages. This decoupling isn't accidental. It's policy tax cuts on capital gains, still 20% max versus 37% ordinary income, offshoring incentives, and weak unionization, only 6% private sector density. Let companies keep the surplus. The result? A hollowed-out middle class where 78% of new jobs since 2010 pay below the 1979 median wage, adjusted for inflation, per Georgetown University Center on Education and the Workforce. We're creating an economy of baristas, gig drivers, and Amazon warehouse workers supporting billionaire lifestyles. And when consumer debt maxes out, already at $18.9 trillion household debt in Q4 2025. Spending collapses, inventories pile up, and the whole Ponzi unravels slowly until mass layoffs hit white-collar too. This is class warfare won by the 1%, and the body count is every dream of upward mobility crushed under the weight of record corporate hoarding. Number 2 is the existential threat nobody wants to name: the accelerating de-dollarization and loss of reserve currency status that's quietly undermining U.S. borrowing power, forcing ever higher interest payments, and setting the stage for a currency crisis that could make 1970s stagflation look tame. Foreign holdings of U.S. Treasuries have fallen from 34% of outstanding debt in 2015 to just 22.8% as of January 2026 per Treasury International Capital data, with China dumping another $78 billion in 2025 alone and now holding under $750 billion, down from $1.3 trillion peak. BRICS nations are accelerating alternatives. Trade settled in local currencies jumped 56% in 2025. Saudi Arabia accepted yuan for oil sales in multiple deals, and the mBridge project, digital CBDC cross-border platform, processed $22 billion in test transactions last year. Meanwhile, the dollar's share of global reserves has slipped to 57.8% from 71% in 2000, per IMF COFR data through Q4 2025. The shocker: U.S. net international investment position is negative $21.4 trillion, a record, and annual interest payments on that external debt are approaching $1 trillion by 2028. To keep foreigners buying treasuries, yields have to stay attractive, but with inflation expectations creeping to 3.1%, University of Michigan survey February 2026, real yields are barely positive, so the Treasury is forced to issue shorter duration debt at higher rates. Average maturity now 5.9 years, down from 7+ pre-pandemic, making rollover risk massive. If foreigners accelerate the dump, say another 5% drop in holdings, yields could spike 100 to 200 basis points overnight, pushing annual interest expense over $2 trillion and forcing either massive austerity, hyper money printing, or both. This slow bleed erodes U.S. geopolitical power. Sanctions lose bite when countries bypass SWIFT and domestic living standards as imported goods get pricier. We're watching the empire's financial foundation crack in ultra-slow motion, and when confidence finally snaps, it'll be catastrophic. Number 1, the final nail in the coffin that ties everything together. This isn't a recession. It's the terminal phase of a 50-year debt supercycle that's now mathematically impossible to escape without pain on a civilizational scale, where the $36.4 trillion national debt, February 2026, grows faster than the economy can service it, interest costs devour the budget, and every quote 12 only accelerates the collapse. CBO's latest baseline projects debt hitting 122% of GDP by 2035 and 166% by 2054. But those assume 2% real growth forever, and no recession's realistic forecasts from Penn Wharton put it at 200% plus by 2040 under moderate assumptions. Interest payments already ate 13% of federal revenue in fiscal year 2025, $892 billion, projected to hit 20% by 2030 and surpass defense plus Medicare plus Medicaid combined. The debt spiral is locked in. Every 1% rise in average rates adds $300 billion annually to costs, and with 30% of treasuries maturing in the next 12 months, rollover at current 4.5 to 5% yields locks in higher burdens forever. There's no way out. Austerity is politically impossible. Cut entitlements, riots. Default is suicide, global banking collapse. And inflation is the only valve, but even 4 to 5% sustained inflation only buys time while destroying savings and wages. The real horror: private debt is worse. Corporate debt service ratios are at 2008 peaks. Household debt to income at record highs for millennials, and state/local pensions underfunded by $5 to $8 trillion. When the tipping point hits, maybe a failed treasury auction, geopolitical shock, or simple loss of confidence, the slow collapse becomes rapid. Yields spike, stocks crater 40 to 60%, banks fail, unemployment surges past 10%, and the dollar loses 30 to 50% purchasing power in a few years. We've crossed the Rubicon. The empire is dying slowly right now, and the only question is how much suffering comes before the final unraveling. This is the end game we've all been living through, and it's too late to pretend otherwise.